Good day to everybody. Thank you for joining us for the 10th year of Do It in Durham Entrepreneurship Week, Durham Region's celebration of entrepreneurship held each November during Entrepreneurship Week. There are over 200 countries around the world celebrating entrepreneurship this week. That's why it's so exciting. And Durham Region, when we say Do It in Durham, what we're really saying is, if you're looking to start a business, invest in a business, grow a business, hire for a business, we're asking you to think about Durham Region. This year, we've got our own scheduling app. So if you're not already using it, check it out. It's a great way to stay on top of all the different events that you have. And it is a wonderful way to connect with new people you've never met. So if you are using the app, consider filling out your profile so that people can easily check in your LinkedIn profile, your Instagram profile, wherever you are, to learn more about you and see if there's a connection. BACD is the leading coordinator of Do It in Durham. However, it is a community event and requires a community effort to pull it together. So we are so grateful to all our community partners who have come together to make this happen. Our premier sponsors, the City of Oshawa, BACD, Invest Durham, Ajax Advantage. Our partner sponsors, Whitby, Canada, the federal government of Canada, there's an economic development agency for Southern Ontario, so that particular branch. KX96 FM, thank you so much. Community sponsors, we've got Ontario Tech University, Brilliant Catalyst, City of Pickering, and the Spark Center. Please, everybody in there, business owners, get the word out, share your experiences with each other this week, share your experience with your followers. It helps increase your visibility. It gives you content to put out there on all your platforms. And I will share with you some hashtags you can use to really help raise awareness and visibility that you're open for business and that these support systems do exist to help you and others like you who are trying to excel in what they do best. My name is Patrice Esper. I'm a business advisor and program coordinator at the Business Advisory Center of Durham. We know it as BACD. And I'll be facilitating this session and monitoring the chat box. So as we go through today's session with Mohamed, if a question comes up, feel free to put it in the chat box. And that way I can, if I see it's necessary to interrupt Mohamed at that time, we will. I know he will stop every once in a while to ask if you have questions, but this is a great way to keep it all together without interrupting. I also encourage you, if everybody's using this opportunity, to network in the chat box by putting in some of your contact details, your website, etc., to share a little bit about who you are and what your business is, then please consider saving the chat. And how you do that is next to your, when you look at the message box, there's a little smiley face or reactions face, and then there are 3 dots. It will say save chat, and then you just click how do you want to save the chat, etc. Let's see. We do encourage cameras staying on for a more engaging experience, especially for the speaker, because they look at our faces to see if there's a response or if they get feedback from it, but it's not it's not necessary. And like I said, I am recording, but for the most part, it will be the speaker and their slides. All right, without much more noise from me, although I think I'm talking and sharing a lot of important information, but that could just be me. Today, we've got Mohamed, who will be presenting reading and interpreting financial statements and also telling us a little bit more about himself. Mohamed, thank you for being here.
Thank you, Patrice. Good morning, everyone, and welcome to today's session, reading and interpreting financial statements. A little bit about myself. I actually grew up in Kenya, which is in East Africa. Started Unique Accounting Services a few years ago in 2015, and BACD was actually the first place that I went to when, just after I registered. So yeah, BACD is very close to what I do, and I really appreciate the help that I got from BACD, and which is what led me to joining the board as a board member in 2016, to the point where I became then the treasurer, and I'm now the chair on the board. I'm also on the board of directors of the Ajax Pickering Board of Trade, And I've been lucky enough in these few short years to be a multi-award winner, whether it's the Reader's Choice, Canadian Business Awards, or the Worldwide Finance Awards. And also, over the past few months, or rather, over the past year, I've been lucky enough to be a contributing author of the Entrepreneur's Toolkit. I'm pretty sure you have most of you have seen that book around this week, and yeah, so I've been pretty fortunate, pretty blessed, and hopefully we'll be able to give you some good content, some good information to be able to help you with your business going forward. um, Accounting is pretty dry. I'll try to make it a bit of an engaging session. So if you have any questions, I do invite questions during the session so that we can make it engaging. We can make it more things so that we're not left with questions only for the end of the session. Um, so reading and interpreting financial statements. When you're looking at financial statements for any business, for any organization, it's actually financial statements are actually a direct window to see your organization's or your business's performance, financial performance. And if you don't read them regularly, or if you don't know how to read them at all, that means that you may be missing out on some opportunities that you may be able to generate more revenue, or um, some tax sensitive information that you may miss during the year. And you can also look to avoid some disasters financially, so that overall, once you know what happens and all that stuff, you can then pick out or point out some red flags that may arise during the year, or even once the year has come to a close. And you can then point them out. If you're working with an accountant or a bookkeeper, you can point them out to them so that they can dig deep and make sure that overall everything works best. Financial statements can help you with stay in control of your cash flow. So there are a lot of ways that financial statements can help you. So one is staying in control of your cash flow. Two is creating and sticking to a budget. So you can also create a budget and make sure that you run your financial statements regularly to make sure that you're sticking to it. And then the other one is you can also spot ways to maximize the tax deductions during the year. Um, you can now when you're applying for bank loans, normally the banks and financial institutions ask for copies of your financial statements. So you can successfully apply for a bank loan through your financial statements. You can also see financial trends in your business. You can know when to spend and when to save. You can make sure that you make some smart financial decisions to help your business grow and prosper, and also show potential investors how your business is performing. So that if at all you're looking to expand and you need some investments, they can make a good sound decision as to whether to invest in your business or not. The main types of financial statements, there are three main types. One is the balance sheet, income statement, or the profit and loss, and the cash flow statement, or which is also called the statement of cash flow. Together, these statements give you and also other people outside of the organization, like investors, banks, financial institutions, a very clear picture of your company's financial position. Going on to the balance sheet now, a balance sheet is broken down into three main categories, three main general categories: assets, liabilities, and equity. Normally, when we're looking at the balance sheet, we normally say that the accounting equation is assets should equal to liabilities plus the equity. Now, and a balance sheet is technically a snapshot of your business finances as it currently stands. So the balance sheet would tell you about the assets you own. So assets are what you own, liabilities are what you owe, or the debts, or rather than what you own, it's what the business owns. Assets are what the business owns, liabilities or debts are what the business owes at a particular point in time, and equity is what you as an owner has put into that into your business. So overall, that's technically the just the um, what the balance sheet looks like. But once you see the balance sheet, that's not the be it and it, in terms of all of that. You need to be able to see. Let's say in our in the thing here, we have cash, equipment, building, inventory. When you're just looking at it overall, you can't really know what you're looking at. You're only looking at some numbers that don't really make sense. In order to make sure that you are looking at it in a way that you can analyze the situation, the values can be used to calculate some ratios that can show the liquidity, efficiency, and the financial structure of your business. Some of these ratios are current ratio, quick or asset test ratio, asset turnover ratio, inventory turnover, debt to equity. Um, Looking at the current ratio is technically just the comparing your current assets and your current liabilities. Now, current assets include items like your cash, whether it's in the bank or petty cash, temporary investments, inventory. Um, your current liabilities are something like short-term loans. When we're talking of short-term loans, that's loans that would mature in less than 12 months. We're looking at wages payable that you need to pay in the next period or in the next few weeks or next couple of months or something of that sort. Trade creditors, so any accounts payable, anything of that sort. Now, current assets, I forgot to mention that also include accounts receivable. That means that what you expect to receive from your customers or clients. Now, normally, as I said, it's comparing current assets and current liabilities. So um, it's technically the mathematical equation is current assets divided by current liabilities. Ideally, it should be more than one. If it's one, anything around one point between 1.5 and 2, it's the best situation. Now, something that to keep in mind is if it's too high, then you can know that that's a red flag that you are um, hoarding or you're keeping away too many assets instead of using them to expand your business, which might affect your long-term business goals and long-term returns. Now, normally, however, businesses should always have sufficient or enough current assets to be able to pay off current liabilities, so which is why it should be more than one. If it goes below one, that's another red flag. That means that it becomes very difficult for the business to meet its short-term obligations. So it would it would be very difficult to for the business to pay off its current liabilities. The quick ratio is technically very similar to the current ratio, but it measures more of the company's or the business's ability to meet its more immediate or more short-term obligations while making the best use out of the what is called the liquid assets. Now, liquid assets are something like cash, uh, whether it's in the bank, checking account, savings account, petty cash, short-term investments that mature in less than a year, and the current accounts receivable, which is which is all divided by the current liabilities. Um, a quick ratio or an asset test ratio of one is normally is considered normal. So which means that it shows that the company is well equipped with enough with enough liquidity to be able to pay off the current liabilities if need be. Um, but if it's less than one, very, very similar to the current ratio, um, it, uh, it means that that's a red flag, and the company is not able to, and it will have difficulties paying off the current liabilities. And which is where it is very important, especially these two ratios to always, whenever you're running a balance sheet, especially for incorporated businesses, to always look to get these calculate these ratios to make sure that there's no red flags, and you know what the company is doing, how the company is doing. The asset turnover ratio tells us about the efficiency with which the business is using its assets. If a company is generating sales from its assets, so which is what the main idea behind those assets is, that it should be able to generate those revenues from what you have and from what the business owns, and it compares the net sales or net revenues with the average total assets. The higher the ratio, the better it is. So, which means that if the ratio is high, it means that the assets are better utilized uh, and efficiently utilized to be able to generate those revenues, and for the profitability of the business. However, a low asset turnover ratio means that a company may be utilizing its assets inefficiently. So, which means that it may experience some issues and some problems. So that there's those assets that the company owns, but it's not able to generate enough sales or enough revenue from those assets, and it's not able to uh, use those assets as efficiently and effectively as it needs to be. Inventory turnover ratio is for those businesses that are inventory based, that are product based mainly, and it indicates the number of times that the company and the business sells and replaces its inventory during a given period of time. Normally, you could say you could calculate it monthly or quarterly or even annually. A high inventory turnover shows that you're selling the products with enough ease. You're selling the products very, very easily, and that your products are high in demand. However, a low turnover ratio means that there is less demand. So you have the supply of your products available, but demand is less for your products, and which means that sales are bound to decline or have already started declining for that period. Debt to equity ratio. This is what normally either investors or banks and financial institutions look at. Is normally is you're comparing the total liabilities and the equity that you've put in. So you're mainly comparing what the business owes versus what you've put into the business. And because the banks are looking at it, they want to decide whether they want to lend you the money or not, and they want to know whether the company can generate enough cash flow or profits to cover all of your expenses. The debt to equity ratio, it is a clear indication of what the long-term ability of the business is to generate sufficient income and to fulfill payments to be able to pay off those debts. If it's too high, that means that the company is it's going on a it's not going on a good note, and it's and you're susceptible to late interest payments or even potential bankruptcy or cash flow issues down the road. I just wanted to pause here, and I know there's a lot of information on this slide. If at all anyone has any questions or anything, then feel free to let me know.
I'm not seeing any questions at this time, Mohammed.
Thanks, Patrice.
Thank you.
Okay, going on. So the next financial statement that we look at is the income statement. Some people call it the profit and loss statement or profit and loss account or something of that sort. The three main categories or three main portions of this are the revenues and sales, the cost of goods sold, and operating expenses. Now, while when you're looking at a balance sheet, the balance sheet is a snapshot of your business's financials at one point at a given point in time. Whereas the income statement shows you how profitable your business is or was over that over a particular period. So that can be just a 1 month period, a 6 month period, a quarter, a fiscal year, or an accounting year, so that you know how much you made in terms of revenue or sales and how much you spent in terms of expenses. Just because your products are profitable doesn't mean your business is profitable. Yes, you may have a gross profit. That means that you have enough of a markup or something of that sort. Um, but you may be spending too much on let's say advertising or rent or salaries, um, to the extent that you're left over with nothing. Very similar to the balance sheet, there's some ratios and some calculations that you need to do or that you can do to be able to gauge the performance of your business. Some of those are um, the gross profit margin, operating margin, and the net profit margin. Now, when you calculate the profit margins, you are looking to gather that information from your income statement into some percentages. Um, a profit margin shows you the relationship between how much you spend and how much you make, so that you're able to get a full bird's eye view of the company's financial performance. Um, in addition to the balance sheet, the lenders and institutions are normally, financial institutions are normally, as well as investors, looking at your profit margins. So they're normally also looking at your income statement and profit margins to see how profitable your company is, so that they can decide whether or not to lend you money, or whether to just decline your applications. Looking at the gross profit margin, that's technically just the gross profit divided by the total revenue. So the gross profit is your total revenue minus the cost of goods sold. Now, cost of goods sold is mainly for those product-based or those in trades that are that have those material sales and all that stuff that you're passing on some of those expenses to the client and customer. It tells us how much income the company makes for each dollar it earns after taking into account the cost of goods sold or the cost of sales. It doesn't take into account any general operating expenses, like any, let's say, advertising, sales, advertising, selling expenses, wages, rent, interest expenses, any income tax payments that you may have made, or something of that sort. Operating profit margin is the total operating income divided by the total revenue. And this one shows what each portion of the dollar, uh, it is the portion of each dollar your business earns or keeps after taking into account both the cost of goods sold and the general business expenses, operating expenses. So you can compare your operating profit margin and your gross profit margin to see how much of your revenue goes towards the operating expenses. So overall, once you have calculated your gross profit margin, operating profit margin, you can then compare what the differences are, so that you can know, yes, my gross profit margin was, let's say, X percent. Operating profit margin would be, of course, lower, but it's Y%. So X minus Y, what the differential is. Am I still in the positive, or am I now going into the negative? If you're going into the negative, that's a red flag, and you would then need to know, and need to check out what exactly is happening in your business. The net profit margin is the total net income minus the not minus, but the total net income. So after you take out, you take in the full gross profit margin, the gross profit minus all the operating expenses, you get the net income. So is the net income divided by the total revenue, and it tells us what portion of each revenue dollar that you can take home as net income. It takes into account all the expenses. So as I said, cost of goods sold, any operating expenses, interest payments, income tax provision that you would have made, and it's the number that you'll continue to focus on, or that you'll make sure that you need to have as a positive, as you read and analyze your income statement, as the company grows, and as you go on, and by growing the profit margin, the you're able to make sure that your company and your business is as efficient as possible.
Excuse me, Mohammed, there is a question regarding this. Sandy is asking, do the banks look at all types of margin or just the net one?
Overall, the banks will look at every single thing, because they want to make sure that with the gross profit margin, they want to make sure that you are pricing your products properly, in order to make that decision. And then after that, they're also looking at the operating profit margin to ensure that you have your expenses are not outweighing your the total revenue or income that you're generating, and also the net profit margin. Now, overall net profit margin, yes, it's looked at by the banks, but not too much, because the first two, the gross profit and the operating profit margins, really tell more about the performance, and they also incorporate the net profit margin, or other the operating expenses as well. So it's a mixture, and you want to make sure that there's enough from the products, especially for product-based businesses, from the products that you're selling. There's enough profitability to be able to cater for operating expenses. Now, when we say for cater for operating expenses, they want to make sure that you have enough of a surplus to be able to pay back whatever principal and interest that the banks may seem that, yes, if we give you let's say $100,000 loan, you'll have to make $2,000, a payment of $2,000 per month. Now, to be able to make that payment of $2,000 a month, banks need to be comfortable enough to say that, yes, by looking at your income statement, that yes, you will be income statement as well as balance sheet, of course. You will be able to make that payment without any issues, because we have to keep in mind that lending us money, or lending any business any money, is a risk that the banks and financial institutions are taking, and they need to make sure that it's a calculated risk, as opposed to something that if it's a negative situation, then more than likely the bank will refuse. So you want to make sure that when you go to the bank, um, you're looking at, or you're making their homework or rather their work as easy as possible, so that they once they look at it, they punch in your numbers into their whether it's the spreadsheets that they're using, their softwares that they're using, to whatever the amounts or the ratios that are generated. You just want to make sure that it's approved, any financing that is approved.
I just added to the chat. It helps them to see that you know your business. It gives them some
Exactly.
confidence.
Exactly, and that's very, very important. One thing I should mention also is when the banks are looking at your financial statements, they're not looking at just the 1 year. They're normally looking at a comparison of a minimum of 2 years worth of financial statements. So you need to make sure that at least over a course of a 2 year period, your whether it's ratios and numbers and everything is as positive and um, good as it should be.
And
The
if,
other, yep,
sorry, Mohammed, I just wanted to interject there because I know a lot of individuals I know that come to BACD, they're just starting out, and hearing that word, that it's as positive as it should be. I just want to, can you elaborate on that? Because it's very typical that when we're first starting out, we actually have more expenses. But when you say as positive, it doesn't mean that we don't have expenses or that we are not making a loss. But what do you, can you elaborate on what you mean by that?
yeah, it's a great point that you brought up, because especially, and you're right, especially for startups or normally for businesses in the first couple of years, 2 or 3 years of operation, it is, yes, there are some businesses that are profitable, but it is more often than not, it's the owner or the shareholder or the director of the business that is really floating, whether it's the cash flow or the operations and all that stuff. Now, and that's one thing. One thing that's there is, of course, when we're saying positive, some of those ratios in the first year or for startups, the first few months of the business will not be positive. But when they're looking at, so the banks, yes, we'll look at the whole, the snapshot as the financial statement as a whole. But when they see that it's a startup or a business in the first year, first couple of years, they will look at the trends. They will ask you for revenue documents or revenue trends. They will ask you for expense trends. They just want to make sure that their risk is as minimal as possible. Now, that may be in terms of guaranteeing you, if you have already incorporated the business, then you may have to sign a personal guarantee saying that yes, you will be, if the business fails to pay, you will be paying the installment payments or whatever the case may be. But um, having said that, when they look at the trend, they want to make sure that it's on an upward trend, and it's and of course, some businesses being seasonal or with some seasons, it could be the trend could be peaks and troughs and all that stuff. But when the banks also look at what industry that you are in, so that's kind of the positive part, that more often than not, yes, sometimes the banks can. It is a misconception that banks, financial institutions, can seem like beasts that are there, but normally, especially when you go to the bank, um, I would advise that you go in person or you set up an in-person appointment with a small business banker or advisor at the bank, so that they can then look at that application. If you make the loan or financing application online, it's an impersonal thing. They don't know who you are. They don't know what's happening in your business. that would they then treat that application as if very similar to a 10-year-old business or a 5-year-old business. But if you're going in person and making sure that you know your small business banker, that shows that you're making that effort to know what exactly is needed and all that stuff, and so that they can look to help you out. Now, most of the time, also those bankers will tell you even before punching in your application, putting in your application through. Once they see the trend and the numbers, sometimes they'll tell you that, you know what, right now it may be very difficult for you to get a loan, but the way you're going, if you do the continue in a similar way for the next month or couple of months, you'll have a better chance of getting that loan or getting that financing. So that could also that may also be helpful for your business. Now, going on to the cash flow statement, uh, it normally tells us how much cash is that you have received and what you have paid out over a particular period of time. They're normally only prepared for businesses that use the accrual accounting method. Now, the accrual accounting method is it measures the revenue and expenses as they as you incur them, as opposed to as and when you pay them. Now, most small businesses, especially sole proprietorships or unincorporated businesses, tend to operate on what we call a cash basis. So that means that they tend to only look at profitability and financial statements or things like that, as and when they incur sales, or when they receive the cash, that's when they record the transaction, whether it's for sales or for expenses. However, for accrual method, it records the sales and revenues that you may have, let's say, invoiced or received a bill for, but you have not yet paid, or that you have not received payment for, or that you have not paid for that expense or the bill for that bill. Now, while you have the income statements that are excellent for showing you how much money that you spend and earn, they don't necessarily tell you how much cash you have on hand for a period of time or for that particular snapshot. Now, what the cash flow statement does, it is broken down into three main sections. One is cash flow from operating activities, cash flow from investing activities, and financing activities. Um, Operating activities, you're looking at anything from your what you have that directly expensed or received from the day-to-day running of the business. Investing activities, what you are putting out or what you are receiving from any investments, whether it's the GICs or any other investments that the business has. Financing activities, it's what you have either received or paid out in terms of any loans or debts or credits that you may have received. Now, what they do is the cash flow statements are very useful for the financial analysis for three main reasons. One is they show the liquidity of the business. That means that you know exactly how much operating cash flow you have in case you need to use it, so that you can know what you can afford and what you can't. The other one is they show you changes in assets, liabilities, and equity in the form of cash outflows and cash inflows, as well as how much cash you have on hand. These three categories are technically, as we saw in the on the balance sheet, are the core of the business accounting. And together they form, as we again, as we saw on the balance sheet, the accounting equation, which is as I mentioned earlier, assets are equal to liabilities and the owner's equity, and they help you measure your performance. Oops. Um, and then what they also help you with is they help you with predicting future cash flows. You can use the cash flow statements to generate or to create cash flow projections, so that you can plan on how much liquidity or how much cash your business would have in the future. It's and that is very important for any medium to long term business plans. So cash flows, you can look to project cash flow statements over, let's say, over a 2, 3, 5 year period of time, and then you can make decisions as to, you know what, 3 years from now, this is what I expect I'll have in terms of cash, so that I can now invest in X, Y, and Z. And on top of that, if you do plan on looking to secure a loan or line of credit, especially for incorporated businesses, you'll need those up-to-date cash flow statements so that you can apply for those loans. Now, overall, once you get used to reading these financial statements, they can actually be fun. I know that's that um, especially after seeing all of these ratios and all of that, a lot of you may be thinking fun, but yes, numbers can be fun. And overall, by analyzing your net income and the cash flows and looking at your past performance, whether it's the trends over the past couple of years, you can see very many ways you can experiment with optimizing the financial performance of your business. Now, without properly prepared financial statements, filing your tax returns can be a nightmare. And believe me, I see lots of nightmares every year. So yeah, without them being properly prepared, it's a nightmare. And they yes, they tell you how much income to report, but they can also give you a full uh, overview or a bird's eye view of the expenses that you've incurred. So you can also look at, yes, you've incurred these expenses. Now, most of them can be tax deductions, and you can also see, okay, I've incurred these expenses, but I also have XYZ expenses that I've not shown inside here, that I may be able to show in order to maximize more of my tax deductions. So overall, that's the full picture that you can get from those financial statements. Any questions? Any comments? Any suggestions? Anything?
Well, I just put in a comment because we talk about the shoe boxes, and I'm like, what? Accountants they don't love shoe boxes full of our data. And I call it data because that's how I perceive it, right? Every receipt shares some information. It shares where are we spending most of our money or expenses. It shares possibly what we're not including and therefore leaving money on the table because we forgot about that expense, like you just said. I'm not seeing any other questions at the moment, but maybe while they're typing it in, I wanted to ask a quick question, because you mentioned, again, we know generally most of us in the session today know that there are different business structure types. Typically, when somebody comes with a business idea, their first question is, how should I structure this business? And for many of them, they're just starting out. So they've not even tested out the idea yet. And we typically say you could start it as a sole proprietor, And two, the question really starts with, what do you see in the next 3 to 5 years with regards to your business? From an accountant's perspective, when is the usual time a person transitions from sole proprietorship to a corporation? Because you did mention that sometimes it's easier as a corporation to apply for things like business line of credit, business loans, etc. So when would that transition typically happen?
So this depends on business to business. It's there's no what's it called? There's no set answer for each and every business. Um, what we look at is from a tax perspective or from an accounting perspective is the tax rate. Now, yes, granted, the corporate tax rates are lower compared to the personal tax rates, but that doesn't mean that every single business needs to be incorporated, or um, or for every single business it is beneficial to be incorporated. Um, we have actually talked down, or rather talk people away from incorporating, as opposed more people away from incorporating as opposed to incorporating, for especially if they're looking at it from a tax perspective, because if you incorporate, that means that the corporation or the business is a separate entity on its own. The individual and the business are now separate different entities for tax purposes. Um, Now, what that means is that you then have to file a separate a corporate tax return, a separate personal tax return. When you are a sole proprietor, and especially for startups, that's what we normally advise as well, as to start up as a sole proprietor. Um, for a number of reasons, unless they're starting up as a franchise, that the franchisee or the franchisor needs the franchisee to be incorporated and all that stuff. But one, the startup costs are very minimal when you're starting up as a sole proprietor, because incorporating, whether you're paying a lawyer or and that's the ideal situation, is rather than looking to do it yourself, look for a lawyer, to a business lawyer, to be able to get the incorporating process. But that there's a cost to it. For a sole proprietorship, you're looking at a maximum of what, $60-$70 for registering with Service Ontario. You get your master business license, and you can look to operate immediately, while keeping your cash flow and costs lower. Um, so now looking at the when you need to incorporate and when you need to transition, um, that's when you're making loads and loads of money. Uh, so when your profitability is on a very high side, that's when it makes more sense. Now, very high side, we normally look at anything over and above $60,000-$70,000 of net income or taxable income. That really you can look to incorporate. But even then, it I would highly recommend to talk to an accountant first, before jumping to incorporate, even at that point in time, because there may be some things that, yes, you may be looking at the profitability, but there may be something that you may not have looked at, that the accountant can point it out to you, that, you know what, yes, look at it that way, and do it. There is also a bit of a misconception that you can that when you incorporate, you are limiting your liability. Uh, yes, the liability portion is there. Um, it's very separate from the tax portion, but uh, as a director of the corporation, you would still have what is called the director's liability. Now, with director's liability, especially when you're the only director, and or you and your spouse are the only directors, it becomes very difficult to still detach yourself if at all anything were to go south. So in terms of liability, a very good insurance policy is the better option as opposed to incorporating for only for liability purposes. And for that as well, if you're looking at liability, I would also advise to talk to a good business lawyer to so that they can advise you as to if you want to limit your liability. Yes, do X, Y, and Z. That's how you'll be able to limit your liability from the business.
Thank you, Mohammed. That was very good information. Sandy's got another great question. Now, this one, what type of insurance policy? So that one I know is honestly, my opinion from a business advisor perspective is to speak with an insurance broker, because they would, first of all, determine, there's an application that you fill out to determine the nature of your business, the type of business, and potentially the type of risk you might be involved with. And then they will be able to get you quotes specific to that. I think, Mohammed, you could speak to about the lawyer aspect to it, because you just brought that up, because it's specific to liability, the essential agreements that can help them waiver
Right.
some of it, right? It won't prevent it, but it'll waiver.
Right, and that's another thing that comes up is now looking at insurance policies. There is, especially if now, not especially, but whether you're working from home and you have people coming into your home, or even if you have an office space and you're a separate office space, you have people or clients, customers coming into that. Liability insurance is needs to be there. If for professionals or something of that sort, you need errors and omissions, E&O. Um, a good insurance broker will also be able to guide you towards good, what's it called, coverage towards business interruption insurance if at all anything were to happen to you as the sole owner of the business. Um, so yes, as Patrice said, there are lots of insurance coverages that you can get. In terms of lawyers, especially when you're incorporating or any types of business documents that you're signing, or any drafts that you're making out, of all that stuff. It is very important to have the lawyer look at them and make sure that whether it's from a liability perspective, and making sure that you have yourself covered, because as a sole proprietor, as a business owner, or as a single sole director of your corporation, uh, you are on the line. Your business is on the line for any agreements that you sign. Wherever your sign goes, whether it's a digital signature or an actual signature, wherever you sign, you are putting your business on the line. You are putting yourself on the line for that, in terms of any liabilities or anything. So highly advisable to talk to the lawyers, even if they get you some templates that you can use to just fill in the blanks for future purposes. You can do that so that your costs are then minimized. You're only paying the lawyer for making those templates.
Great. Thank you very much, Mohammed. The time now is 11:10, so we still got about 5 minutes. Anybody else have a question for Mohammed? Okay, I'm not seeing any activity in the chat box. Mohammed, do you have any closing words that you'd like to share?
Well, what I normally advise is, yes, there have been a lot of over over the past 45 minutes, an hour, a lot of information, a lot of ratios and all that stuff. I'm pretty sure some of you, yes, right, not right now, but you may be confused as to what these ratios and what happens if X happens and things like that. Highly advisable to have an accountant. So when you're starting up, I'm pretty sure the business advisor at BACD, and that's the advice I got as well when I started, is have an accountant in your corner, have a lawyer in your corner, so that if you have any questions, you can lean on them. Most accountants, especially for startups, don't mind giving you advice without charging you an arm and a leg, or without charging you by the hour. So take advantage of that and make sure that you're building that long-term relationship between your business and the accountant and the lawyer, and also with a financial advisor, so that all of you can then work together, streamline everything, streamline your processes to be to make sure that everything is working for your benefit and for the well-being of your business.
Excellent. Thank you so much, Mohamed. And thank you for putting up that screen. Again, thanks to all our sponsors and collaboration partners for another successful Do It in Durham. 10 years, 10 years. Thanks to each and every one of you who showed up today and participated, your questions, your shares in the chat. We appreciate it very much, and feel free to reach out. You're not alone on this journey. Thanks, everyone. Be safe out there. Stay warm.